All right. Welcome, everybody. Today is Friday, October 10th. This is the Chevron benefits summary. As you see, my colleague Brian and Penny are here as co-hosts. We are going to walk you through the Chevron benefits. There's a lot to go over, and we're going to focus mostly on the health insurance. And then there are some ancillary decisions that do need to be made down the slides. So we're going to alternate speakers. And Penny, if you would, feel free to share your screen. What you see here is the open enrollment is from October 20th to the 31st. So it's a bit of a small window to make these decisions, which is why we're hosting this webinar early so that you can feel confident in making these decisions as you get into the system. Okay, starting with the health insurance, you have 4 different health insurance plans. And what we're going to do on this call is whittle this down a little bit to the 2 plans that you really want to consider. Starting on the left-hand side, in terms of the whittling process, you see this medical HMO plan. We don't have the rates for these for this policy, and the coverage varies by region, and most people wouldn't want to choose an HMO anyway. So because there's not enough information to even analyze the plan itself, this first slide is really starting by taking this one off the table. From there, the medical PPO is one that Brian's going to cover more in detail. We'll also talk about the high deductible health plan. And as we move to the next slide, we're going to talk a little bit about the high deductible basics. So for now, HMO off the table. What's important as we walk you through the presentation, we are going to assume wellness credits for all the premiums. In order to earn the wellness credit, you need to do that within the year. So if you look on the bottom in bold there, in order to qualify for the wellness credit for 2026, you need to have all your obligations met by the end of this month. So if you don't have your 1,000 points yet, and you qualify for points for doing various, I don't know, tasks, I don't know if task is the right word, or meeting certain obligations, doing certain things. You can think of it like a game. So certain things have more points, other things have lower points, but you need 1,000 points in order to qualify for the wellness benefit, and it needs to be done by the end of this month. The benefit in doing that is that your premiums are reduced, and for a variety of the plans, including the family plan, you can save up to $750 a year by meeting all of the obligations to qualify for the wellness credit. Okay, next process in terms of the whittling. The high deductible healthcare basic plan, as you'll see in the middle, it has a higher deductible than the regular plan, a higher out-of-pocket maximum, higher co-insurance. So there are multiple reasons why you would not choose this plan. So as Brian and Penny and I were preparing for the call, we're asking ourselves, who would choose this plan? And it's in a very odd situation where someone has the coverage, but they don't plan on using it, because the only slight benefit is there's a slight smaller premium, slightly lower premium, but the moment you go to try to even use the plan, it's going to cost you more. So why do you have the coverage anyway if you're not planning on using it? So for that reason, high deductible basic, not really something that we want to consider. Okay, Brian.
Yep. So thanks, Chris. So now that we've whittled it down to the really the main plans, what we're going to do here in the next several slides is compare the costs of the PPO and the high deductible health plan, the HDHP, and go over those costs, those features, so then you can make the decision based on your personal and your family situation, choice between the 2 plans. So here, this chart here basically shows the premiums involved with both plans. So as it's pretty obvious, the PPO plan from a pay period premium perspective is much more expensive, regardless if it's the employee only, the employee plus one, or a family plan. So when you compare those premiums on the left side, which is the PPO, with the ones of the HDHP, you can see there's a substantial difference. And as Chris mentioned before, we assume the wellness credit applies for these premiums we show here. Just for FY, if you do not qualify for wellness credits, the differential, the dollar differential between the two plan premiums is around about the same. So regardless, there's going to be a differential. And as you can see here, like just for the family plan, there's quite there's nearly 4,750-ish dollars between just the premiums between the two plans. And then in addition to that, for the HDHP plan, and Chris will go over the HSA a little bit later, Chevron contributes anywhere from $500 to $1,000 towards your HSA or your health savings account. So that will give you even more savings that is realized in the sense that a Chevron is contributing money to go towards your medical. So besides the premium, they will also give you that benefit of additional funds that they put into your account. On the PPO, HSA does not apply, but there is a healthcare flexible spending account available to you if you should want to use that plan or use that type of account. So now that we've looked at the premiums, we'll go a little bit over this table here to see why you may want, even though it's more expensive from a premium perspective, why the PPO may be more beneficial for your family and your situation as opposed to the high deductible healthcare plan. So starting at the top, you will see the deductibles. So the deductibles for the PPO are smaller compared to the high deductible healthcare plan. So you can see, depending on if it's individual plus one, or family, all the levels of the deductibles are annual deductible is smaller for the PPO. So that's one factor. Your out-of-pocket max is equal for both of them. So that's really not as much of a factor. And Chris will cover more of the details of that, of what the possibilities are as far as maxing out the plan, et cetera. But at least for these purposes, the out-of-pocket max remains the same between the plans. One of the key differentiators then between the PPO and the HDHP, as you go down and look at the services and the amount that you would pay for each of the services, this is where it comes into a personal situation on what plan may suit you and your family the best. So let's start over to the right side, which is HHP. You'll see for basically all the services, anything but except for preventative care, whether it's primary care, specialist visit, urgent care, everything's a 20% co-insurance amount. And that co-insurance amount that you would pay only happens after the deductible is being met. So if you look at the top, the deductible, basically you're paying 100% out of pocket until that deductible has been met. And then after that deductible has been met, then you would pay 20% of the amount of that particular service that you or your family are using. That's where the difference is between the PPO plan and HDHP plan comes into play. So we look over at the PPO plan, just starting at the top, preventative services is once again, it's no charge, similar to the HDHP. But as you start to move down, like your primary care visits, your specialist visits, your urgent care, those have a co-insurance amount, but it's capped to a dollar amount copay. So as you can see there, for primary care, 10% co-insurance, 25 up to a $25 copay per visit. And the deductible does not apply in those cases. So basically, you don't have to fulfill the deductible obligations for that coinsurance or that copay to come into play. Specialist visits are the same. You're going through down there, emergency, urgent care, emergency room. And then we start getting down into more of the complex, the more involved, like outpatient surgery, diagnostic tests, hospital stays. Those are equivalent to the HDHP in the sense that you pay 100% out of pocket up until you meet the deductible, and then the co-insurance applies. Just to give you an example of, for your personal situation, for you to evaluate PPO and HDHP, let's take a situation into account like specialist visits. So say, for example, you have some type of therapy, like physical therapy or some other recurring type activity that you have throughout the year, where under the PPO plan, you pay 10% co-insurance. So say, for example, you go to a physical therapy session, it's $100. The full value is $100. 10% co-insurance, you would pay $10. However, in the HDHP plan, because the charge is $100 and assuming you haven't met your deductible yet, you would pay the full $100 for that service. So that's where the cost differential comes into play, where if you've got frequent visits to specialists, maybe urgent care, emergency room, of course, those aren't necessarily planned, you may want to consider the PPO plan, because over time, you'll be paying less per visit, and that dollar differential between the PPO and HDHP will start cutting into that savings that you're seeing through the premium. And just give you another example, emergency room visit. This is for the emergency room only. It's not necessarily for any prescriptions or medical devices or anything else that you would, x-rays, for example. Under the PPO plan, you would pay $250 copay. Say emergency room visit was $2,000. You pay $250 for the PPO plan, but then for the HGHP, assuming you hadn't met the deductible yet, you'd be paying that full $2,000 out of pocket up until the time you meet that deductible amount. So that's where it comes into play, and you just have to evaluate on your own personal circumstances on which plan may suit you better from a medical perspective. So next we'll move into the pharmacy side, prescription drug benefit. This is also another differentiator that you may determine one plan's better than the other. So in the case of a PPO plan, you note there at the top, it has a separate deductible and a separate out-of-pocket max. So the deductible is anywhere from $150 to $300, and the out-of-pocket max is anywhere from $1,800 to $3,600. That's a separate from your medical deductible and your medical out-of-pocket max. The HDHP plan, it has a combined deductible with the medical. So basically, there is not a separate deductible for prescription drugs, and there is not a separate out-of-pocket max. So why this is important is the fact that, if you do have higher dollar or frequent prescriptions, whether it's generic, preferred, or non-preferred, you have that separate deductible and that separate out-of-pocket max for your drug coverage, which is relatively low. If you look at the family, the deductible is $300, the out-of-pocket max is $36. You don't have to, it's totally separate from the medical side. So there's a possibility if you're relatively healthy, you don't go to the doctor a whole lot, but you still have some prescriptions you have to take. The cost for those could be less under the PPO plan, because what happens with the HDHP plan, those other out-of-pocket max deductibles for medical applies in those cases, which are much higher. So it's another case of where you may be paying 100% for example, a generic drug. retail, mail order under HDHP, you're paying co-pays, but that's after the deductible has been met. Now met, and that's that combined deductible. In the case of a PPO plan, you're doing a $5 copay after the drug deductibles has been met. So it's not as large of a deductible. And then for mail order, the deductible doesn't apply. So once again, it's another one of those cases where if you got a lot of prescriptions or high dollar prescriptions, that may tilt the overall cost into the favor of the PPO versus the HDHP.
Okay, beautiful. Thank you, Brian. So what we're looking to do here is create themes. So there's a theme for why would you choose the PPO? And then if you're not, if as Brian was describing this, you're thinking like, well, that doesn't totally apply to me, then you're in this other group. And I'm going to walk you through the math on considering the high deductible health plan. So the first thing about the high deductible health plan is that there's an account called a health savings account, which you may be aware of. The benefit of the health savings plan, number one, is that Chevron contributes to your account on your behalf. So you see those benefits there on the bottom part of the slide. Additionally, any deposits that you put personally into the plan are tax deductible. And so for next year, so the family coverage is $8,750. Chevron's going to kick in $1,000 on your behalf. So you can put $7,750 into your health savings account. We suggest to people to do that earlier in the year, in January, in a lump sum. The reason is that then you have that money on your card and you're ready to spend it if you need it. Additionally, if you've used the health savings account for a number of years now, and maybe you've accumulated a balance, you can take a portion of that and invest it and grow those funds. Now, there's risk associated. It'll go up and it'll go down. It'll go up and it'll go down, but you can grow that money and it's not just sitting there in cash. The yellow part of the portion of the slide here is highlighting the tax benefit. As we're going to walk you through the analysis, we are not including the tax benefit of if you're in the 24% bracket as a family, you'll save an additional $1,860 on your federal tax alone. If you're in the 32% bracket, you can see that number just under $2,500 in federal tax reduction. So that's meaningful savings. We did not even factor that into the analysis because this is very personal. Who knows what each person's tax bracket is. Okay, we're going to walk you through two different dynamics, one as an individual and one as a family plan, whether you use the plan or whether you have a good year and you don't use the plan. So this first one is an individual comparing the PPO, again, in the wellness, to the high deductible health plan. You see in green right in the middle, savings and cost without using the plan, meaning you have the coverage and you go through the year and you go, I had a good year. Nothing really happened. I didn't have a lot of issues. Well, if you were on the PPO plan, the cost for you is $1,374. On the high deductible plan, you're getting a credit of $500 and there's no premium. So you're actually coming out ahead by $1,874 plus the tax benefit that we highlighted below. Okay, going on to the next slide. What if you, as an individual, use the plan and you meet the out-of-pocket maximum? So you see that in yellow, the out-of-pocket maximum is met. Looking on the left side, the PPO plan, you're going to have your premium, you're going to have your out-of-pocket maximum of $5,000. So your total cost for that year is $6,374. If you're on the high deductible plan, you're getting a $500 credit into the HSA account. It's the same deductible. So Brian highlighted that earlier. The deductible is exactly the same. So when you factor this in, your all-in cost on the high deductible plan is $4,500. So you're saving the same number. You're saving the $1,874. Okay, let's look at the family plan.
Well, hang on. Keep in mind, Chris, that this number right here is not including the prescription deductible or out-of-pocket max that's required under this plan. So we just cut that out. It got too complicated. So this number right here is just medical. It's not prescription. So I want to throw that little nugget in just to make sure you clarify where the amounts are.
Thank you. Thank you. So, okay, here we have the family plan. So if you look in the middle, draw your eye to the middle in green, it says savings and costs without using the plan. So when you have a family dynamic and kids in any given year, you don't know. You don't know if it's like nothing's going to happen this year or you're going to have a big year and it's like, yeah, would this happen and we hit the out-of-pocket maximum, we use the plan. So we're going to show you both. On the left-hand side on the PPO, if you have a good year and you never use it, your cost is just the premium, $49.86. On the right-hand side, the high deductible plan, premium minus the contribution that Chevron is contributing on your behalf. So you're actually coming out ahead. You're receiving so your all-in savings differential is 57.64. Now, what if you have a year where you use the plan and your out-of-pocket maximum has been met? On the left-hand side, on the family plan, out-of-pocket maximum is $10,000. Your all-in cost just under $15,000, $14,986. On the high deductible plan, you're getting a credit on the premium side, the same out-of-pocket maximum. Again, the out-of-pocket maximum is exactly the same. So now your all-in cost is $92.22. So you're saving $57.64 just the same. So you're coming out ahead, plus the tax benefit that we highlighted earlier before we went into this analysis. And then to Penny's point, it applies the same. So if you have prescriptions or there are other ancillary things that are going into this what if scenario that we're creating, those are ancillary costs that aren't even in the $14,986. Whereas on the high deductible plan, all the prescriptions, all the pharmacy stuff, all of that is working towards your out-of-pocket maximum. So it's a theme. Thematically, if there are specialists, if there's consistent things, physical therapy, like Brian mentioned, or prescriptions, if thematically if that's resonating with you in that first part of the call that Brian reviewed, that could be something. If you have questions, feel free to reach out. We've done this analysis for other families to see which one's better. If thematically that doesn't apply to you, then likely you'll want to be on the high deductible health plan. And this is one of the main reasons we host this call. All right. That I think covers health insurance. And now we're going to move on to our other sections.
Thank you, Chris. Yeah, that was a lot to unpack. Health insurance is always confusing. Always this time of year is a little bit stressful trying to get the last quarter going and just make enrollment decisions. As Chris said, we're here to help. Please reach out. That was the biggest portion that many people have questions over. The rest of our webinar is going to be covering some of the other parts that Chevron offers. Starting with dental. Dental, you have two options. They're both with Delta Dental. So it's a great, well accepted program across the nation, the Delta Dental program. You can have a PPO or a HMO. Both of them have 100% preventative cleaning. So if you're in network, so that's awesome. There's usually a max of $2,000 per year. It's same with the PPO this year. It did not change. They'll cover a percentage of any treatments on the PPO plan, $2,000 max. Orthodontics, they'll cover 50%, but the lifetime maximum is sticking with $2,000. No change in that one. For the HMO, they're going to break out every procedure on how much you have to pay. The best thing we can do is say, go look at the brochure, go look at the document to decide if this is the right option for you. Carrying on with the rest of the health insurance, we have the vision. You have two options under the vision plan. One is VSP Vision Basic. It'll just be basic coverage plan. Then there's an upgrade option, which will have a little additional cost, a Vision Plus program. And what that does, it provides you with basically an allowance where if you're on this plan, you have an allowance for how much they will pay toward your frames, toward your eyeglass lenses, or contact allowance. So you know your family best. You know how many of y'all are in glasses or contacts and which one would be best for you. We just wanted to let you know that you have 2 options again this year. Moving on, dependent care. So through Chevron, through your benefits, you have a dependent care spending account, kind of like a FSA, but this is only for your dependent care needs. The limit for 2026 published limit is $3,750 per year if you're single, and $7,500 for married. Keep in mind that you can allocate money directly from your paycheck and it will be counted as pre-tax dollars. So you're not paying taxes on this amount and you're putting it from your paycheck into your dependent care spending account. It is a use it or lose it account. So you need to calculate ahead of time and do a budget. And it only applies to activities that happen during the calendar year. So that's January of 2026 through December of 2026. However, you have a little bit extra time to make your claims. So that frees you up a little bit in December. You're not trying to get all your paperwork in. They give you a little bit of a window. So appreciate that opportunity through the dependent care spending account. Next, we will go to other health plans and programs. Just a few changes or things just to be aware of. The mental health and substance use disorder has changed from Beacon Health options. It is now Carelon. So if you were previously utilizing Beacon, be aware there's a change that they're using Carelon now. Again, they have the website, virtual visits, 24 hours a day for any type of either parenting, depression, family problems, relationship difficulties, or even problems at work. And another program that we caught that we wanted to highlight is the diabetes prevention care. And this is through OMADA. I believe that's how you pronounce it. And so it is an online program designed not only if you already are a type 2 diabetic, but if you're at risk, if your doctor has flagged you as being at risk for type 2 diabetes, you can jump on this program and you can start making changes to help you document and kind of get a coach to help you manage your stress in your sleep patterns and your movement. So keep those in mind.
All right, so I'll jump in here in this next section, starting with life insurance. So the company is going to provide 2 times your annual pay, up to $10 million on the basic. From there, you can also select supplemental life, which is anywhere from 1 time to 8 times your salary, up to the $10 million limit. By taking the supplemental coverage, you can also insure a spouse up to $250,000, as well as the children, which can be covered up to $20,000. The short-term disability, there are 2 components here, and Brian, I may ask you to chime in here to provide a little added color. On the job disability, you have 26 weeks of the full regular pay. Off the job disability, 6 to 26 weeks of regular pay. And then there's a component of half pay. It's an interesting policy because with the long-term disability kicks in after 6 months. So Brian, is there something you can highlight within this?
Yeah, sure. Yeah. So really, and to clarify, to add on to the long-term disability, it's got a elimination period or kick-in period of 26 weeks, or actually when the short-term disability program completes. So for example, if you're an employee, if you're a long-time employee of 15 plus years, you qualify for, let's look at the off-the-job disability. If you had an off-the-job disability, you would qualify for 26 weeks of full regular pay and 26 weeks of half pay. So that'd be a full year. The long-term disability would not kick in until those banks of weeks have been fully fulfilled. On the other side, if you're a new employee, a relatively new employee of less than 2 years, you get 6 weeks of regular full pay for short-term disability, and then 6 weeks of half pay. So that's 12 weeks there. But there will be a period because of the 180-day wait period for long-term disability, or 26 weeks. There will be a period, like if you're a younger, a newer, or spent less time with Chevron, there's a period there where your short-term disability will expire and your long-term disability won't kick in until 6 months or 180 days down the road. So that kind of gives you an idea. It's the on-the-job disability is 26 weeks full, 26 weeks half for everybody, regardless of your tenure at Chevron. But the off-the-job disability, it's all dependent upon how long you've been an employee, and that varies over a period of six weeks or a 26-week period.
Okay, thank you. So the long-term disability, based on whether on the job or off the job, and to Brian's point, based on your tenure kicks in at 180 days. There are two decisions that are important about this. Your basic coverage covers 50% of your regular pay. You have optional coverage that you need to elect, and we would suggest that you do this to step up your coverage up to 60% of your regular pay. For a subset of Chevron employees, you may qualify for the benefit restoration plan. If that's ringing a bell for you, there's a second component of optional disability coverage that needs to be elected, and we would suggest that you do that. If you have any questions and you qualify for the benefit restoration, feel free to reach out to us. We can highlight where to make that selection. But if you have the benefit restoration, there's an ancillary election we want to make within the long-term disability. Brian, let me turn it over to you on the 401k.
All right. So we'll cover here the 401k or otherwise known as the ESIP. So as many of you already know, you're immediately eligible to be paid if paid on U.S. payroll. As long as you contribute at least 2% of your regular pay, Chevron will contribute 8%. They'll do the 8% match, or not match. It'll basically contribute 8% as long as you do the 2%. And we're going down to the bottom there. That 2% is what we call the before tax basic. Beyond the before tax basic, or it can be either pre-tax or on a Roth basis. Typically, most folks, we recommend doing the pre-tax. Then beyond that 2%, you can have the before tax supplemental or Roth supplemental. And then on top of that, there's an option, if your cash flow allows it, to do some additional after-tax supplemental, which all the way up to the IRS limits for that given year. So for some of those folks that have families already do this, this is what we call the mega backdoor Roth opportunity. So not to get down in the weeds on that, but just we could talk to you further if you're interested in that opportunity. But you have your basic before tax, or basic and supplemental, or the Roth, and then some additional opportunities to go beyond that to do an after-tax supplemental and do a mega Roth to increase your savings opportunities.
Let's talk numbers. What does that look like in real time, Brian, for 2026?
Yeah, so for 2026, these ranges as far as the contributions can change each year based on what the IRS elects. So for 2026, the pre-tax and Roth, the standard limit is $24,500. If you're over age 50, there's different, and depending on where you are in the 60s, there's different catch-up limits that actually get stacked on top of the standard. So if you're anywhere between the 55 to 59 range, or you're older than 64 or older, you've got 8,000 eligible on top of the 24,500. The IRS had implemented something that gives you an extra catch-up capability if you're getting close to Medicare age, So if you're age 60, 63, you can actually do up to 11,500 extra, which would, if you did your standard and the catch up, that would take you up to 36,000 maximum. And as mentioned before, there's some after-tax contributions available on top of that. So on top of that, for all ages, the potential after tax, which you would enable you to potentially do the mega backdoor Roth, you have an additional 47,500 that you can do on top of that if your cash flow, your family cash flow allows for the extra savings. You just got you can supercharge your retirement account with that, and then that total contribution limit, depending on your age, will change. But that's the max IRS limit, total contribution limit. That includes your contributions, company contributions, all in. But you can put away up to, all the way up to, if you're in that 150 to 59 bracket, 64 plus, or 60, 63, you can put up to 83,500 into your ESIP or your 401k account. And then on that, so let you know you get your annual bonus paid in March. So this ties in a little bit to your ESIP, your 401k, because you will have, if it's a good year with Chevron, you'll get a nice bonus. And as part of that bonus will actually go towards your 401k. So basically, you'll take your standard paycheck by paycheck contributions, but on that bonus payment, you'll have a lot going over to the 401k or your ESIP. And one of the things that we recommend is for us to revisit your savings rate after that bonus occurs. You're basically will be putting additional amounts towards those limits that we looked at previously, and that may require us to make, or require you to make, edits in your contribution rates with respect to your before tax or your after tax supplemental, in order to kind of even it out through the year, so you can put away the most you could, most possible, to your 401k.
All
And with
right.
that, I think Chris will take us through additional benefits here.
Yeah, thank you. So your pension's a big deal, and pension has a variety of inputs that go into the calculation. As you see on the top here, you're vested after 5 years. If the pension's on your mind, you've likely been here more than those 5 years. It's dependent on age too. So as you get older, there's a point of actually diminishing returns. So you want to run multiple analysis of your pension to see how your pension's affected based on your age and based on your tenure. It's also affected by interest rates. So for example, think of it like a seesaw. When interest rates go down, your your pension value rises. And so we've had years of rising interest rates. So you may have seen colleagues who left a few years ago before interest rates were rising, because they knew that their pension benefit was going to go down. Well, now that we're in a different environment and interest rates will likely continue to go down, if you're getting close to retirement, your pension is really something that you're going to want to take a look at. So that pension modeling tool is available, and you're going to want to make sure that you're taking a look at that. Okay, looking at your benefit restoration, your supplemental retirement plan. If you qualify for the benefit restoration plan, the technical term for that is called a non-qualified plan. It's for particular high earners. At retirement, you receive that in the form of a lump sum. The benefit is tax deferred. So if it's a year where you qualify for the benefit restoration plan and you have questions, let us know. There are decisions that need to be made. It can be a little intimidating, but if you wanted someone to guide you in that process, we're happy to give you some thoughts about how to make decisions as it relates to the benefit restoration plan.
All right. Thank you, Chris and Brian. That's a lot of information on retirement, different ways to maximize. And you have lots of decisions, lots of options, as Chris said. And Brian said, we're here to help you make those decisions and work through them. I'm going to jump back to family care. So family care, there are lots of opportunities for family care and other resources that Chevron offers. In those, we're just going to highlight a few. So definitely go look at the website to get a big picture of all of them. But let's just start with some. So family care, you automatically get 1 week per calendar year for family care. What does that look like? You have a sick kid, you have a sick parent, whatever that looks like, you have 1 week. Then you have an additional 7 weeks of extended family care. But keep in mind, this is not like January to December. It's not a calendar year. It's per 12 months. So if you took off July 1st, that first week for someone got sick or got the flu, whatever the case is, you have to wait until the next 12 months, so that of the next year, before you're eligible to utilize your extended family care. Jumping down to work-life balance and other resources, Chevron offers you bonding time off, whether you just had a child or you just adopted, whatever the case is, you have time off to bond with them. You have children learning and behavioral assistance, whether that's learning disability or challenges like dyslexia, ADHD, or just need tutoring in math. Who doesn't need tutoring in math? So you have opportunities in those areas through Chevron benefits to resources that have already been vetted. There is legal services and grief resources available. You have critical illness insurance offers. You have business travel dependent care. Say you have to go on a business trip for Chevron and you need to bring your kids. You can go through the Chevron program and find out the vetted and approved babysitters or caregivers that can come in and assist you with your kids while you're in that board meeting or whatever the activity is. Additionally, there is a hospital indemnity insurance. I worked on that word. Apparently I failed it, but I have been working on indemnity. Jumping down to fertility, Chevron even helps you so much in the work-life balance. They are providing through opportunities through Win Fertility to help with up to $60,000 to help infertility struggles with preservations, storage, surrogacy, 20,000, and even adoption care, and help you with the cost to adopt. So they're 100% on board. I love all these benefits. I love their attitude toward families, and I think they're great areas. You know what works best for you. Jumping forward, home and auto insurance. Okay, this was a new one to me. I thought it was pretty neat. We're always shopping around for what is the best insurance for us. How do we get the best rates? You have opportunity through Chevron to go ahead and utilize them for personal and casualty insurance at group rates. And not only that, you can deduct the costs from your payroll, from your paycheck for your premium payments. Pretty neat. Keep in mind that they use farmers for their group select. California, you have your own rules, so you need to check with what's available in your area for California. And they cover everything from home and auto, renters, boaters insurance, landlords rental dwelling, recreational vehicles, motorcycles, and even umbrella. So kind of a neat area. I was not aware of that. So if you're interested, there's lots of information you can do to volunteer benefits for Chevron. Keep moving forward. Long-term care insurance. Okay, this is a great one too. So the long-term care insurance program is available through Chevron. They contract through Genworth. And as with most all long-term care insurance policies, there's a monthly maximum and a lifetime maximum that is allowed through the insurance program that you can use. But if you need long-term care, it's a great one to have. There's various coverage levels. Maybe you only want a little, or maybe you need more. You're able to choose that. It has the different levels. It's not just a one-time or one amount level. So that's great. Portability. That is one of our favorite words when we look at long-term care insurance. So basically, when you leave Chevron, you can take this long-term care insurance that you have covered and move it into retirement or whatever the next phase of life is. That's really important because as you get older, it's harder to qualify for long-term care, or it's more expensive just to start one fresh. So definitely look at that, consider that as opportunity. And when you're doing your open enrollment, keep in mind underwriting is required. So because it's a very important insurance product, they are going to require underwriting. Their certificate of coverage covers all the basics, nursing home, assisted living, home care, adult care, and respite care. Jumping real fast into accident insurance, Chevron offers accident insurance for on the job. So if the accident happens and you're on the job, you're covered. You can also elect voluntary insurance and include your dependents in it, which is your spouse and your child. There is coverage amounts and maximums to look at. But one of the features that I wanted to highlight is Chevron business travel. You're automatically enrolled as an employee if you're doing travel for Chevron. And so it's included in your benefits package. It's 3 times your annualized regular salary, up to 1 million. And if your spouse is on the trip or your children are on the trip, they can be covered too. So great little things Chevron's making sure that you're taken care of if they assign you to travel. And that is all I have. Chris, I'm going to turn it back over to you.
Yes, thank you, Penny. Thank you, Brian, for walking us through this material. This is what we have on tap for you. So open enrollment begins on the 20th to the 31st. Our hope is that you found some value in this presentation, even some clarity and confidence to be able to make the decision on what you feel is the right plan for you. If you have any questions or you just want that extra validation that you're making the right decision, feel free to let us know. But have a great rest of your day and a great weekend. Talk to you later. Bye-bye.